What if you could profit from a stock going down while knowing exactly how much you could lose before you even enter the trade? That's one of the biggest advantages of a bear put debit spread. But there's a trade-off. Your risk is limited. Your cost can be lower than buying a put outright, but your profit is also capped. So how does this strategy actually work? In this video, we'll break down the bear put debit spread step by step, look at a simple example, and show you how to calculate the maximum profit, maximum loss, and break-even price. Let's start with the basic idea. A bear put debit spread is a bearish option strategy. You use it when you expect a stock to move lower, but you want to define your risk before entering the trade. The strategy uses two put options with the same expiration date. You buy one put at a higher strike price, and you sell another put at a lower strike price, because you're paying a net premium to enter the position. It's called a debit spread. Here's a simple example. Let's say a stock is trading at $100 and you believe it could fall toward $90 over the next month. You could simply buy a $100 put for $6. But instead, you could buy the $100 put for $6 and sell the $90 put for $2. That gives you a net debit of $4 per share. Since one options contract represents 100 shares, your total cost would be $400. And that $400 is also your maximum possible loss. Now let's look at the potential profit. The difference between the two strikes is $10. You paid $4 for the spread, so the maximum profit is $10 minus $4, which equals $6 per share. That's a maximum profit of $600 per contract. So right away, we have three important numbers. Your maximum loss is $400. Your maximum profit is $600. And your break-even price is $96. You get that break-even by taking the higher strike, which is $100, and subtracting the $4 debit you paid. Now let's see what happens at expiration. If the stock finishes above $100, both puts expire worthless, and you lose the $400 debit. If the stock finishes between $100 and $90, the $100 put has value, while the $90 put expires worthless. Your actual profit or loss depends on where the stock finishes. But if the stock falls to $90 or below, the spread reaches its maximum value of $10. Since you paid $4 to enter the trade, you keep the remaining $6 as profit. That's how you arrive at the $600 maximum profit. So why use a bear put debit spread instead of simply buying a put? One reason is cost. Buying a put outright can be expensive, especially when implied volatility is high. By selling the lower strike put, you collect premium that helps reduce the cost of the long put. But there's an important trade-off. The short put also limits your upside. If the stock crashes far below $90, you don't continue making more money. Your profit is already capped at $600. That's why strike selection matters. You don't want to choose strikes just because they make the spread look cheap. You need to think about where you expect the stock to move, how much time you're giving the trade, the implied volatility, liquidity, and whether the potential reward is worth the risk. Another common mistake is forgetting about time. A bear put debit spread is bearish, but that doesn't mean you automatically make money just because the stock eventually goes down. The stock needs to move in the right direction, and ideally it needs to move enough and soon enough for the trade to work in your favor. And you don't necessarily have to hold the spread until expiration. If the trade reaches your profit target earlier, you may decide to close it and take the profit. On the other hand, if your bearish thesis changes, you may decide to exit before expiration rather than simply waiting to see what happens. So let's bring everything together. A bear put debit spread involves buying a higher strike put and selling a lower strike put with the same expiration. You pay a debit to enter the trade. That debit is your maximum loss. Your maximum profit is the difference between the two strikes minus the debit you paid. And your break even is the higher strike minus the debit. The strategy can be useful when you have a bearish outlook and want defined risk. But remember that the potential profit is capped. And that brings us to an important question. How do you actually choose the right strikes for a debit spread? In the next video, we'll break down how to select strikes for debit spreads and show you how strike selection can affect your risk, reward, break even, and probability of success. Successful options trading isn't about predicting every move. It's about building a framework for making high probability decisions, one trade at a time. That's it for today, traders. I hope you found this video valuable. If you did, hit the subscribe button and turn on notifications so you never miss an update. Leave a comment below and let me know your thoughts on this video, or tell me what options trading topic you'd like me to cover next. Your support means the world to us. See you in the next one.